Welcome back to DigiTutorials. Today we are covering what CCPC means and the tax benefits that are involved. In Canada, a CCPC stands for Canadian Controlled Private Corporation. It is a specific classification of corporation under the Income Tax Act, and qualifying as a CCPC provides access to several significant tax advantages and deferral opportunities for private businesses. A Canadian-controlled private corporation, CCPC, is defined as a private corporation that meets the following conditions at the end of the tax year. 1. Incorporated in Canada or resident in Canada from June 18, 1971, if incorporated prior. 2. Not controlled directly or indirectly by one or more non-residents of Canada, public corporations, or a combination of public corporations. Corporations controlled by any combination of non-residents and public corporations. To qualify as a CCPC, your corporation must meet the following conditions at the end of the taxation year. Condition requirement: incorporation, incorporated in Canada, private status, not publicly traded, Canadian control, not controlled directly or indirectly by non-residents or public corporations, shareholder residency, majority ownership by Canadian residents. Being a Canadian-controlled private corporation, or CCPC, opens the door to substantial tax incentives, both at the corporate and individual shareholder levels. One of the key benefits is the lower tax rate on active business income. The first $500,000 of active business income, in most provinces, qualifies for the small business rate, which is much lower than the general corporate tax rate. Combined federal and provincial rates range from around 9 to 15% on qualifying income, depending on the province. Shareholders of a CCPC can claim the Lifetime Capital Gains Exemption, or LCGE, on the disposition of qualifying shares. As of 2025, the exemption is up to $1,016,836, and it's indexed annually. This applies to qualified small business corporation shares, effectively allowing tax-free capital gains up to the limit, subject to certain holding period and asset tests. CCPCs conducting scientific research and experimental development, often referred to as SR&ED, can receive enhanced refundable tax credits. The refundable rate is up to 35% on the first $3 million of eligible R&D expenditures. This benefit applies only to Canadian-controlled corporations with taxable capital under $50 million. A CCPC can defer personal taxation by retaining profits in the corporation rather than paying them out as salary or dividends. Business owners have the option to delay paying personal tax until funds are withdrawn. Many federal and provincial programs like IRAP, Canada, Job Grant, and others are restricted to CCPCs. They may also have better access to government-backed financing, such as BDC loans. You know, if you lose CCPC status, you may lose access to the Small Business Deduction, refundable SR&ED credits, and other preferential treatments. Immediate taxation can occur, meaning some deferred tax benefits may be accelerated. Additionally, if a corporation loses its CCPC status, for example through a sale to a foreign entity, the tax year is deemed to end immediately and a new one begins. Let's go over some of the benefits. The Small Business Deduction reduces the tax rate on the first $500,000 of active income. The LCGE offers up to approximately $1 million in tax-free capital gains on share sales. The SR&ED credit provides up to a 35% refundable tax credit on research and development. Tax deferral allows you to retain earnings in the corporation to defer personal tax. Lastly, government incentives mean more eligibility for programs and grants. So, if you're starting or operating a private corporation in Canada, ensuring it qualifies as a CCPC can be a powerful planning strategy. However, eligibility and compliance are nuanced. It's wise to consult a tax advisor to maintain CCPC status and maximize your benefits. Please share if you find this video useful. See you in our next session.